Hello, everyone, and welcome to Currency Exchange, NatWest podcast series all about foreign exchange markets. I'm Brian Daingerfield. I co-head G10 FX strategy here at NatWest, and I'll be the host today. It's really been an interesting start to the year. You know, in the first couple podcasts of 2026, we talked a lot about how volatility had started the year at very depressed levels. But in the last couple of weeks, that has changed pretty materially. So, lots to talk about in FX markets at the moment. And to talk about all things FX, I'm happy to be joined once again by Paul Robson, who heads G10 FX strategy with me covering out of London. Paul, thanks so much for joining. So, Paul, I want to start with the Bank of England. So we're recording on Thursday, the 5th of February. And, as we often do when we record on Thursday morning here in the U.S., the Bank of England is just fresh off the presses. What did you take away from today's Bank of England meeting?
Yeah, as you say, it's still very fresh. I think the headline will be a dovish hold markets, and we weren't expecting very much from the Bank of England today, certainly in terms of the policy rate. We and market pricing very resolutely behind the idea there would be no change in the policy rate from 3.75. We ultimately think that we'll get a final cut from the Bank of England in Q2, and I'll talk about that in a few moments. But I think the interest was more on the vote count and some of the commentary around inflation coming lower and wage setting. So it just had a slightly dovish feel to it. It was one of those events where we got the whole lot of sort of the monetary policy report. We had the press conference, we had the minutes, and importantly, the sort of individual paragraphs from the members of the Monetary Policy Committee that gives us an insight. And the reason that that's important is that the Monetary Policy Committee looks very split. You have four pretty well-defined doves on the committee, pretty much four well-defined hawks, and you have the sole sort of swing voter in the governor, how he votes also decides on whether policy is going to shift, because he's the one that shifts it in either in terms of 5-4 for on hold or 5-4 to cut rates. I mean, the expectation was actually for 7-2 that we'd only get two people, the two key doves on the committee, voting for a cut at the February meeting. That's Taylor and Dingra. But in the end, we had Ramsden and Breeden also voting for a rate cut, which surprised the market. Reading through the various parts of it and listening to Governor Bailey in the press conference, it feels like they're a little bit more confident that inflation is going to come down more quickly this year than they previously expected. It'd be important to see how lower actual realised inflation starts to impact inflation expectations. And here I mean in terms of wage growth and wage settings, because that will ultimately determine whether easing inflation pressures can bring inflation sustainably down to target. We still feel on balance that the next cut, as I said, will arrive in April. Futures markets have sort of brought forward the expected timing of that cut, and they're sort of pretty indifferent between March and April, but on balance, just more likely it comes in March. The reason that we stick with April is really we're not sure they're going to get a lot more data that can give them confidence that wage growth is falling and inflation's coming down to sustainably down to target. So it felt like a dovish hold. The surprise was in the vote count, but it doesn't change our view of the outlook. We still think it's the next cut more likely to come in April than at the March meeting.
Yeah, so I want to back off maybe into UK assets more broadly and away from the specifics of the Bank of England, because we have seen a pickup in volatility in UK assets, including the currency. How are you thinking of some of the drivers of that in the last week?
Yeah, sterling had actually traded pretty well this year. It's carried on its good performance following the November budget. But as you say, in recent days, the currency has weakened, bond markets have weakened, bond yields have moved higher. It feels like that's highly correlated with a pickup in political uncertainty. I'll leave it to others to talk about the reasons for that shift. It's widely reported. All I will talk about really is just the correlation between increased uncertainty about the political outlook, leadership change, and how investors might be thinking about the impact on the currency. And it's very similar to the bond market. They're pretty much the same. In terms of the correlation, investors have marked sterling lower when they have worried that you get a change in the political landscape that ultimately leads to a dilution of fiscal policy in the UK. You had a number of episodes over the last 18 months. It's pretty clear from the movement in asset prices and pick up in uncertainty. Fiscal rules, maybe about debt sustainability, maybe at some point rise over a shift in the Bank of England's mandate. And it just leads to a greater risk premium for the bond market. And I'll be covering this in a separate podcast, the Bondcast, that will be released at a similar kind of time when I will talk about the gilt market and how it impacts through risk premium, but inflation premium. But for the currency, I think it's just seen as the release valve. If people have a position in UK assets that sometimes quite hard to change and adjust quickly, it's easier to take a view on the currency as a sort of insurance for those positions. So the answer to your question, Brian, is just very much politics, and we'll see how that plays out. There are a couple of dates on the calendar. We've got the May local elections. We've got a keenly watched by-election at the end of February as well, and what that might mean for the fiscal outlook and economic policy for the rest of the year, I think will matter for sterling. And so therefore despite sterling having a good start to the year, we've always been a bit cautious on how far this can run because of these lurking uncertainties which have come to the fore this week. In terms of this week, like you said at the beginning of the call, there's been lots of moving parts, and the geopolitical developments. There's obviously been a big focus on Fed independence. We obviously got the nomination for the new Fed chair, Kevin Warsh. I was just wondering if it changed if it did change your view on the Fed policy outlook and crucially the dollar.
So I think the nomination of Warsh very interesting and has certainly repercussions on the interest rate side in terms of the shape of the curve. And it happens to be in the direction that we expected, which is towards a bias for steeper interest rate curves, because Kevin Warsh, relative to other candidates, has a long and storied history of being a hawk on balance sheet policy, of having been skeptical of the role of expansive quantitative easing. Warsh has a long history of having suggested that he wants the balance sheet to continue to run down, and that running down the balance sheet is a form of passive tightening that can offset some loosening in monetary policy. So while Warsh is certainly more hawkish than some alternatives in terms of his views of balance sheet policy, we don't think his views on front-end interest rates are all that different from what we're hearing from a lot of individuals who are in Trump's orbit. Now, Kevin Warsh, has a history as a balance sheet hawk, but his views on monetary policy are very similar to what we hear from individuals like Treasury Secretary Bessent, CEA Director Kevin Hassett, and others discussing the ability for front-end rates to move lower. And I think from Warsh's side, there's a sort of hawkish iteration of this sort of desire for front-end rates to move lower, which is if you remove some accommodation from lowering the balance sheet, that can unlock additional ability to maneuver on front-end interest rates. And so we continue to expect the Federal Reserve under new leadership to resume easing of front-end interest rates. We're actually a bit more dovish than the consensus in terms of the amount of easing that could be coming in the back half of the year. I don't think Warsh changes that outlook all that much, even though I think the market's interpretation is that of the established candidates, and call it the final four of Trump's candidates, that Warsh as a nominee is on the more established hawkish side. But that hawkishness is primarily related to balance sheets and not as clear on the interest rate side. One of the things that we've also been tracking is markets' expectations around challenges to Fed independence. I think the market sees Warsh as a vote in favor of Fed independence because Warsh has a history of having been on the Federal Reserve. His experience as a governor back in the late 2000s, I should say, gives him a sense of credibility, maybe a little bit of inside baseball as someone who has been in the Fed, respects the Fed as an institution. But I think the market should be cautious in interpreting the views of Kevin Warsh and his role at the Fed from 2006 to 2011 as compared to what he would be in 2026 and beyond. Because it's clear that just as all of us evolve, that his views have also evolved. And so we still think that Warsh will be coming to the Federal Reserve with a strong bias to easing interest rates. Perhaps you could argue that as someone with Fed experience and perhaps some credibility in the mind of the market and the mind of lawmakers, he could be more effective in pulling the Federal Reserve in that direction. So continue to think that front-end interest rates, the risk to front-end interest rates still points to the downside, even though Warsh is seen in the market as a somewhat hawkish candidate. That hawkishness is primarily related to balance sheet policy. And I see his balance sheet policy as an expression of let's unlock some additional capacity to cut front-end interest rates. And, we talked about this a lot, Paul, that the dollar's relationship with front-end interest rates, differentials, that has weakened quite a bit. So we certainly can't just say blankly that lower front-end interest rates is something that's going to one-for-one lead to dollar weakness. You used to be able to make that point pretty clearly that carry was really the only game in town for global currencies, including the dollar. But I continue to think that the downward pressure from lower interest rates in the front end is probably still coming. I don't think Warsh changes that, and continue to think that points to continued downside for the dollar as we approach this period where the Fed resumes easing, while most central banks at that point are probably close to finished, if not on a more definitive pause.
It definitely sounds like there's still a lot to play for in terms of that monetary policy easing cycle in the States Fed independence, certainly in sharp contrast to the ECB policy decision that we've just had. And I'm just going to run through, if you don't mind, just a few of the key points there. But it certainly just gives confidence, doesn't it, that one of those of our 6 key themes for 2026 was this idea of monetary policy divergence, where you've got this idea that the ECB is not cutting any more of it. It's reached terminal. You've got the Fed potentially easing more aggressively. You've got the Bank of England easing a little bit. And of course, you've got the Bank of Japan that might be raising rates. I'm really keen to hear what you think about Japan's lower election at the weekend and what you're thinking on the yen. Just on the ECB, it's also interesting just how it feels like we'll be talking about the Fed a lot more than the ECB this year. They left rates on hold at 2%. They're expected to do so. I think I say it most weeks. Inflation's at 2%, inflation expectations at 2%, and inflation's expected to be 2% in 2 years' time. So there's really not any reason why the ECB should shift. And I think for the currency, it's again, like you said about the shifting correlation between the dollar and rates, it feels that the euro will be more a function of general sort of risk appetite and also perhaps the level, if there is a higher level of drama or policy uncertainty around the States, and whether that ultimately supports the euro. It does sound that you were discussing about the Fed that euro dollar higher through the year might be something that markets want to romance later on. So policy divergence very much still in play. So back to Japan and those lower house elections. How are you thinking about that in terms of the outlook for the yen?
So I think it's important, I will touch on that in a second, but I do want to just touch on the broad price action that we've had in dollar yen leading up to this, because I think that's important to give the context, which is the big drop in dollar yen that we had that was seen as the Japanese MOF coming into the market and executing a rate check, effectively going to dealers and asking them at what level they could buy the Japanese yen in the market. And that's an important pre-step in a possible FX intervention. And what's super interesting is that it's been widely reported that the Federal Reserve also conducted an interest rate check, an FX check in the market as well. And so lots of questions about the U.S. and strong dollar policy have played a role in these big moves in yen that we have seen. Is Treasury signaling some loosening, some maybe weakening of its strong dollar policy? Treasury Secretary Besson has come out pretty strongly pushing back against that impulse. And so dollar yen has seen a bit of a rally back from its local lows in the aftermath of that move. Now, we know now, based on MOF data, that they did not actually intervene in FX markets as part of those big moves lower in dollar yen a couple weeks back. And that's that combination of drivers, the fact that it turns out MOF did not actually intervene, and Besson pushing back against strong dollar policy, a weakening in strong dollar policy, has seen dollar yen rebound quite a bit in the last couple of sessions here, giving back a lot of those gains. So that's the context which we enter into this election. But some of that weakness in yen likely reflects the fact that the fundamental backdrop for the currency hasn't really changed meaningfully. The Bank of Japan, broadly speaking, continues to slow play the importance of the currency as a driver of upside risk to inflation. Policy doesn't appear to be extra sensitive to that. We didn't get a strong sense from Governor Ueda at the January meeting that the Bank of Japan is seeing the conditions in the currency as requiring a much more hawkish posture. I think the market sees that as a signal that very low real rates, negative real rates, are likely to stay for the foreseeable future. That remains a challenge for the currency. Additionally, the Takaichi trade, this idea that additional fiscal stimulus is going to come with the Takaichi government, rising fiscal risk premium into the Japanese currency as well. I think that's been a part of this move, and that the fundamental backdrop for that has not really changed, despite the fact that the market has been sort of forced to consider these risks around intervention. So now we come back to the election. What has changed? On the fundamental side, not all that much. Clearly, the biggest change in the yen market has been this question about intervention and whether or not the U.S. strong dollar policy has been changing. Clearly, they've rejected that notion. But on the fundamental side for the political picture, recent polls have suggested that Takaichi and the LDP are in very good position to secure a majority in the lower house. The big gamble that the Takaichi government engaged in when calling this election was that her government is quite popular in the Japanese populace, but polls were telling us that the LDP party was not as popular as the prime minister. And so the gamble here was, what if Takaichi calls a election to try and capitalize on her own popularity, but the rank and file LDP really doesn't benefit? What we've seen more recently is polls appear to be breaking in the direction of LDP outperformance, to a point where if polls are correct, then LDP looks in a good position with their coalition partner to win a majority. And so I think the market sees a clear path towards additional fiscal stimulus, that Takaichi, assuming that polls are correct, she wins a mandate to push for additional fiscal stimulus. And so it sort of invites that Takaichi trade to come back in. And so, one of the things that we have been writing and discussing in the aftermath of the reported rate check and the potential intervention was that these moves don't change that fundamental backdrop for yen, which is that we have a picture of aggressive fiscal stimulus, an election that looks likely at this point to give additional green light for fresh fiscal stimulus, give Takaichi the majority that she seeks. And additionally, that interest rates remain deeply negative in real terms, and that the Bank of Japan's policy doesn't seem to be as sensitive to weakness in the currency as perhaps the market's been expecting for a while. So from the fundamental side, continue to think that the yen faces a lot of challenges here. We do expect a broadly weaker dollar, so don't get me wrong, we can see dollar yen lower at the end of this year, for sure, if we get a broadly weaker dollar. But it feels like there's better currencies, I think, to express a weaker dollar view than yen, which continues to face, I think, challenges from a combination of very dovish policy still, and expectations for fiscal stimulus, which look likely to be validated by this weekend's election if polls are correct. So we've covered a lot of ground here, so maybe we'll call it there. Thank you very much, Paul, for your insights as always, and to our listeners, thanks so much for listening. If you enjoyed the podcast today, please consider giving it a like and also subscribing so you can get our latest content the moment it's released. Thanks so much.